All right, we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcoming you back here for another post-Federal Reserve Open Markets Committee release, as well as you get our reaction here to the recent Jerome Powell press conference that just happened about 2 hours ago or so. As usual, I am joined by one of my very favorite people to interview, Axel Merk, noted Fed watcher and obviously head of the Merk family of funds over there at Merk Investments. Axel, how are you doing today?
I'm hesitating to answer because I'm doing just fine, and Powell was not able to put me to sleep. No.
Okay. Well, you're kind of pulling a Powell. There were several questions that he deliberately didn't want to touch today that he passed on. But I'm not going to let you do that. We actually have to talk about this. So, folks, we're going to do what we normally do. Axel and I will give our reactions to the news today from the Fed's release and what Powell had to say at his press conference. We will then open it up to questions from you, the audience. So we'll take as many of your live questions as we can. Make sure to ask those in the live chat there. All right, Axel, well, look, perhaps not as many fireworks this time around as the last time we did this, when the Fed cut but spooked the markets. Markets pretty much got what they were expecting today. They were expecting the Fed to pause. The Fed indeed did not change its policy rate. It has not altered QT either. So it's kind of just continuing what it was doing. I guess I would say if there was any sort of surprise today, just reading media pieces, people were sort of going into the meeting with Powell looking at this as a dovish pause. And I think the tenor coming out is maybe it's a little more of a hawkish pause. Not much to make the markets really do much. But anyways, any surprises in here for you? Anything notable you're immediately taking away from today's announcement?
Well, we've talked in the past, right? I've said, why on earth do we have these press conferences in the first place? And think about it from the Federal Reserve's point of view. Why did they create them? Why do they have them? And it was in the name of increased transparency. Well, judging on that metric, I think that gets an F today. There was no increased transparency. There were a whole bunch of traps laid by the journalists, not in order to trap them, but just asking questions based on the politics of the day. And Powell really talked in circles. And so you got to wonder why did they have the discussion? And of course, why do we have a discussion talking about that? Well, the reason we have the discussion is because he does control the bazooka. The Federal Reserve does set the reference point for the at least official interest-free reference point and guides the yield curve. And all asset prices are priced off that. And so we do have to pay attention to what he says. And that's part of the problem, of course, right? We're supposed to anchor somehow, have an anchor of stability that guides this economy. And we're listening to the results of a discussion of a debating club. And Powell kind of had it every which way today. He said, we are tight, we are accommodative, we are watchful, we're in a good place, we don't need to move too fast. He contradicted himself a gazillion times with the goal of not really saying anything. And in between, he was given a bunch of political questions, given the context where we are with the new administration. And he had to dodge those questions. And I guess he came out okay at the other end of it. But again, you got to wonder why he has these conferences in the first place. And one of the things he said, I was all excited about it. We can talk about that as well. He said they've started their 5-year review and they're going to wrap it up, I think, in September, he said. So we can talk about that later as well. But the short of it is he tried to say nothing, and in some ways he did succeed at
that. Okay. So this was kind of a Seinfeld press conference for the Fed, right? It was really all about nothing. Yeah, so it was interesting. He again did a lot of repeating what we've heard from him recently, which is that, hey, look, we think we're in good shape. We think the trajectory is where we want it to go. Yeah, inflation is taking a little bit longer than we want. They changed their language in their the FOMC release to say that it's still elevated. sort of somewhat elevated, as Powell took pains to say. But he still believes that the current policy rate is restrictive enough that given enough time, it's going to pull inflation down to the Fed's 2% target. What I find interesting is he kept talking about how, despite cooling, the labor market was, quote, solid. He mentioned that word solid an awful lot. Talking to or listening to the journalists, they were less confident about that. And clearly they've been talking to people in the real world. And one of them actually said, hey, Chair Powell, you're saying how great the jobs market is, but we're talking to real people and they're actually having trouble getting jobs now. And Powell actually did admit, he said, well, yeah, you're right. I mean, the hiring rate's coming down. We've been watching that. And he basically said, the jobs market at this point in time, he said, it's a good market if you have a job. If you're looking for a job, it's a tougher environment out there. And he did say, we don't want to see any more cooling in the labor market. So kind of out of one corner of his mouth, he was sort of saying, hey, we're congratulating ourselves. We've cooled the labor market a bit, but unemployment's still low. Hooray for us. But he's also saying, I mean, we don't want it to cool anymore because it's getting hard for folks to find a job. So I don't know. I feel like he is maybe putting a little too much lipstick on the labor market than it deserves. What do you think?
Well, let's take a step back and think about the really impossible situation the Fed is in. We are coming from the backdrop of high inflation, and inflation has been coming down. If history is any guide, once inflation is high, it's no longer linear. So there is no guarantee whatsoever that inflation is going to be well behaved, which means the Federal Reserve has to sound tough in some ways. The Federal Reserve also has a dual mandate that they're supposed to look at both inflation and jobs. And until Greenspan, that meant we look after inflation and the job market is going to take care of itself. Ever since then, and Powell in particular has at least talked up the jobs market. Ultimately, they just have one big tool, which is interest rates, right? So we are making a big hoo-ha about one little thing that they might be want to controlling. And then they have lowered rates. Markets, for the most part, appear to be quite excited. People still invest in meme stocks. I heard that some Trump coins were created just before the inauguration and things like that. So there is certainly a lot of enthusiasm, irrational exuberance, Mr. Greenspan might have said, in the markets. And so, and part of the question was also, hey, is the environment too easy because this sort of stuff still happens? And that's when Powell then came in and said, oh, no. I mean, the labor market has been softening somewhat, and we don't need it to soften any further. He also pointed, and one of the challenges is that nobody, and he said as much, knows where the quote unquote neutral rate is. He did say that the rate is above where anybody on the FOMC thinks neutral is, and that based on what they see, they're above neutral. But there's no rush to ease. Note, he didn't say he's in no rush to tighten. There's clearly an easing bias. So the folks who said, hey, he was more hawkish, I don't know. I mean, he was on an easing path, right? And so, but what you do here, because and what you should have is you should have a model. You should communicate a model. But he doesn't have a model. And of course, last time around, that came out crystal clear when people gave their projections and everybody priced in their own hysteria, what Trump is going to do, and saying, all right, rates are going to be higher because we're going to have this and that. And that's not exactly what you expect from this temple where they make these godly decisions. No, it's a bunch of folks in a debating club trying to figure out what's next, and they have no clue. So the best they can do is stay put and try not to cause too much damage. I think that's really what the state they're in. My own view is that if they actually had a strategy, communicated that strategy, everybody would be much better served.
Right. So we've talked about this an awful lot about your criticism of the Fed, that it needs a framework, and instead it's just kind of more of we're making it up as we go along kind of said. And I was thinking of you a lot today.
Just to be clear, the folks at the Fed will, of course, strongly disagree with what I say here, because they, of course, insist they do have a framework. But to just take them at their word, their framework is a 5-year-old framework. Remember that backward-looking inflation averaging. That is the current framework. And now there's having a few months, they're going to revise it. They've never had a proper introspection about the major screw-up. I think that's a CFA level 4 term. They had that they let inflation get out of control. And in September or so, they want to wrap up the 5-year study and have a new framework. Now, I get it that if they really have a new framework, maybe they don't want to let the cat out of the bag and all that. But in the meantime, we're in this vacuum where they're really just reading tea leaves. And of course, the reason why they're reading tea leaves is because they got used to that after 2008. After they controlled the entire yield curve, they took the gauges away of the economy, and they dictated what's happening throughout the yield curve. The Federal Reserve is ever more micromanaging what's happening in the economy. I'd just like to remind folks of that bailout that the small banks got for mismanaging interest rate risk. So if you micromanage everything, what are you going to look at for guidance going forward? And the only thing they can look at is really in the back rearview mirror on inflation. And that's a pretty bad guide about how to set rates going forward. And that is the corner they've painted themselves in. And I guess for that, he did a pretty decent job in not saying anything for an hour.
Yeah. Well, like I was about to say, I was thinking of you a lot here, that you must have been getting increasingly frustrated with him. One, because he was evading and not really saying anything new. But also because, he kept basically saying, look, I can't really give you the answers you're looking for. We're just going to look at the data as it unfolds, and we'll kind of know when we see it, when we need to take action, right? Which again is not framework dependent. It's very reactive, right?
Keep in mind that Fed policy, of course, acts with a lag, right? And so, I mean, there's a law in physics that an object that's in motion tends to stay in motion, and then obviously monetary policy isn't physics, but an economy is in motion, right? And so if you only react with after the fact, you're almost bound to overreact.
Right.
I don't know whether anyone here has ever tried to ride a unicycle. Try to do that by reacting late. You're never going to be able to sit up on that unicycle for more than a few seconds, right? It just doesn't work. If you want to keep things in balance, you gotta have a little bit more finesse, and that you don't just whip that out of nothing. It takes a framework, it takes a structure. Now, of course, the Fed would say, hey, inflation expectations are anchored, we can afford to do what we do. And of course, that is correct. But just take that a step further. One of the things he was asked and talked about a little bit is about tariffs, right? How do tariffs affect inflation? And in some ways, you can say, oh, tariffs might adjust the price little once and whatnot. But one of the dangers is that in an environment where people have been used to higher prices, that companies might be then use tariffs to further increase prices, and that could unsettle inflation expectations, right? And the same, of course, with the massive deficits we have. And Powell tried to push against that by saying, oh, people are fed up with high inflation. Well, that's not what history shows, right? Once things get out of control, it's pretty bad. And the good news is that the markets are reasonably well behaved when it comes to inflation expectations, but you cannot take that for granted.
Yeah, it was interesting when he was talking about asking questions about tariffs and whatnot. Again, he was pretty evasive. He said out of one corner of his mouth, "Oh, our staff models all sorts of different scenarios, so we're looking at the full spectrum of things that might happen." But basically saying, but in terms of like what weight to put on these probabilities, we don't know. It's way too early. We're just going to wait and see what goes on, right? So it was a lot more still of just like.
I think somebody zapped him. I think somebody zapped him halfway along the way, or said, "Hold. The reason why he doesn't want to go down that road is because the more the Fed enters political turf, the more they're inviting, obviously, political backlash." And so at some point he caught himself and says, no, I'm not saying anything about tariffs, right? And at the same time, yes, of course, they need to model what might happen and what could happen. And just here for kind of, in theory, right? Of course, if tariffs are put on imported goods, those goods are more expensive, but in some ways it's a one-off increase in price. Now, in practice, it doesn't work that way, because there's going to be a retaliation by other countries, and so you're going to have several shocks in different directions, and then you're going to have policies that retaliate against those retaliations, and it can get pretty ugly. And the question is what the Federal Reserve should do, standing in the middle of all of that. And historically, they don't have a track record of being good at that.
No, they don't. And in just a minute, I'm going to talk about President Trump's reaction to Powell's press conference.
Adam, I just lost your audio, and I think you might see that on your side as well. Last time this happened, I was happily able to talk while you were trying to figure things out. So I can talk about you, Adam.
Yep, I'm back. I'm so sorry, everybody. This happened last time.
Yes, I was just talking about you while you were not listening. So
yeah, it's okay. So whatever abuse you heaped on me was well deserved. No, this happened last time too. I literally just took a screenshot of something, and I think that froze the available short-term memory on my computer. But why I was taking that snapshot, which I'll hopefully bring in here, is you said Powell was really choosing his words around tariff because he didn't want to invite political blowback. Well, it took about 3 nanoseconds before President Trump responded to the press conference and was not very happy about it. And to connect that dot, we have Powell, doing his best not to really say anything, not having a framework, as I know frustrates you. All the questions about tariffs or other, whatever uncertainty lies out there, he kept basically just saying like, well, we're just going to wait and see. And then somebody asked him the question of, well, there's this whole focus now on government efficiency. Is that going to apply to the Fed? And do you think you're overstaffed? And of course, he
said Elon Musk has said you guys are overstaffed. So wasn't even talking about his own opinion. Exactly. And his response was, we have a solid budget process. And I don't think whether you noticed, he shrugged his shoulders quite a bit. He was during this press conference, like saying, oh, don't give me that crap, right? Give me a real question. And it's one of the reasons why I says, what has the Fed to gain by having these press conferences, right? Because how can you answer this question and shine? Because it doesn't further the mission.
Sort of inviting it by basically just saying, like, I can't really give you any straight answers. So it's like, well, then why do you have these thousands of PhDs if you can't tell us anything?
Yeah, no, and he was of course asked, hey, there's been an executive order. What are you going to do about it? And then he gave a kind of a boilerplate answer and says, we work to, align ourselves with executive orders and do them to the extent they're consistent with applicable law. And then he was asked the question, apparently Dodd-Frank created an office for women and inclusion or something like that. And then Powell very curtly just says, as I said, consistent with applicable law. So obviously, if the law requires you to have it, he's not going to get rid of it. But again, right? I mean, what? I'm going to defend him now, the poor guy. Right? What is he going to say? And more broadly, why on earth does he have a press conference in the first place when he just sets himself up? And you said, right, Trump lashed out afterwards. Well, that's exactly the sort of thing that he's inviting. So my view is you talk when you have something to say.
Yeah, and let me just read this, Axel. So for the folks that are listening over a podcast and can't read this, because Jay Powell and the Fed failed to stop the problem they created with inflation, I will do it by unleashing American energy production, slashing regulation, rebalancing international trade, and reigniting American manufacturing. But I will do much more than stopping inflation. I will make our country financially and otherwise powerful again. All right, all sounds great. But then he really starts taking swings. The Fed has done a terrible job on bank regulation. Treasury is going to lead the effort to cut unnecessary regulation and will unleash lending for all American people and businesses. If the Fed had spent less time on DEI, gender ideology, quote, green energy, and fake climate change, inflation would never have been a problem. Instead, we suffered from the worst inflation in the history of our country. So taking a lot of big swings there at the Fed, not all of them totally black and white. I mean, a large part of the inflation as well were the fiscal stimuluses that were done at the same time. But Powell obviously starting to feel the full wrath of the new president. We know they've had a history laced with friction. This definitely seems to set the tone. Trump has been saying and demanding, in days leading up to today, that the Fed's got to bring down interest rates. Folks actually asked Powell that. What do you think about that? And he said, well, I haven't heard directly from the president. And more or less, he said what he could, which is we're independent. We're going to continue to be independent. But clearly, the squeeze is on in terms of Trump's pressure on the Fed. Do you think the Fed is going to be able to remain fully independent here of Trump? And even if so, does Trump has ways to kind of, get what he wants or most of what he wants through other channels, like maybe leveraging dissent at Treasury?
Well, you've raised a whole series of issues. So first of all, I think Trump can be very lucky that he's dealing with the Fed, not the ECB. He would have had a heart attack if he had to listen to Lagarde, I think, because the Lagarde has been explicitly political, whereas at least Powell is trying to stay out of it. Trump, the way I look at Trump, he tends to use hyperbole to express something, but directionally, he often has a fair point. And also keep in mind that the Fed is, of course, the favorite punching bag for anybody in leadership, right? Because the moment you can blame the Fed, you don't have to take responsibility for something yourself. That mostly applies to members of Congress. A lot of the things that the Fed does is because Congress has made the Fed do these things, right? The Fed didn't come up with Dodd-Frank. Congress came up with Dodd-Frank, and Powell has to execute it. And so you're kind of stuck with the law, adhering to the law. Now, clearly within that, you can strike a balance, right? I mean, I mentioned earlier that Greenspan talked about the employment mandate being met perfectly well if you just focus on inflation, whereas Powell very clearly goes out of his way to try to do both. And Powell has given numerous speeches on trying to help all the small communities with monetary policy, which of course doesn't work because monetary policy is such a broad brush that you can't do it. So some of that criticism is very well warranted. And on the bank regulation, well, part of this challenge is that there's so much micromanagement going on, and there's a lot of blame to go around. The regulatory environment is a big element of that. Dodd-Frank is a big element of that. But yes, the Federal Reserve has tried, and that really went into high gear with Bernanke into trying to micromanage the economy. And Bernanke wrote a book during the pandemic where he kind of gives his vision of a future Fed, and all the stuff that the Fed has done since the financial crisis is just the beginning. And that was before the kind of the rescue ring was given to the small banks. And what that basically means is that, yes, the Fed is also going to take ownership of all the mess that's out there. Remember that before the Fed, and even in the early years of the Fed, or early decades, it wasn't the job of the Federal Reserve to take care of every problem that was out there. Recession, even depression, was considered to be part of the cycle. Obviously, back then, maybe we were on a gold standard and whatnot. But ever since the gold standard was weakened and then given up, the idea was that some magicians at the central bank can take care of everything. So to answer your question, Powell will, of course, continue to be in the crossfires. Powell will be all right. The question really is what's going to happen next. Powell's term is going to run out, and I think it's in March of 2026. And so the important portion is how will the next person act? And in what areas will that person be independent? In which areas will that person be not independent? When it comes to setting
you're talking about Powell's successor, right?
Yes, yes. Yeah.
Okay, so middle of next year, there's a new federal chair. Yeah.
Yes. When it comes to setting interest rates, the reason why central banks talk about independence is because it lowers interest rates when the central bank is independent. When you abuse interest rates for political purposes, then inflation tends to be much higher and outcomes tend to be much worse. But of course, the moment the Federal Reserve goes into political territory, and to me, that started when the Federal Reserve started buying mortgage-backed securities, because monetary policy is about providing overall credit to an economy. It is not about allocating credit to a particular sector of the economy, and even mortgage-backed securities is that already. And with banking regulation, if you coerce banks to lend for climate initiatives, that has nothing to do with monetary policy. And the reason why it is such a bad idea to do that is precisely because it invites the sort of criticism that Trump is exerting. So why I don't agree with the hyperbole necessarily that Trump does. Powell and the Fed only has themselves to blame for getting to the stage.
Okay. And the stage we're at, right? I mean, you said pretty clear the Fed has an easing bias. It would like to be cutting here if it could. It is pausing right now because of inflation, right? Inflation is just proving stickier. You know, it's in many ways, it's the Pareto rule. Getting the first 80% of the inflation down was the easier part. It's the remaining 20% that's a lot harder. Let me ask you this. So I have an interview coming out tomorrow with Lacey Hunt that I just recorded yesterday. Folks watching, it's going to be awesome. You should definitely watch it. And Lacey is still pretty much on team deflation. And I will say, I think Lacey's a little bit more optimistic longer term than I'm used to him seeing. And it's because he actually thinks that some of the policies the new administration are pursuing may actually be beneficial to the economy, but it's going to take a while to get from here to there. And in the interim, he thinks that the forces that are going to determine where things go are going to be much more on the deflationary side going forward. And I'm not going to go into all the reasons for that right now, folks. You can watch tomorrow's video. But one thing which was mentioned in the Q&A with the press conference was, you know, someone asked him about housing, and you know, he basically said that you know, it makes up a big part of CPI, and we are now actually beginning to see rents start to decrease. And so as the shelter component goes down, because it's like 40% or something like that of CPI, the overall CPI basket, that really should start pulling the inflation rate down over time. So I'm just curious, Axel, given your perch, where do you think the risks lie over the next year? Inflation being stickier than the Fed wants, and potentially maybe even, you know, languishing where it is or going higher? Or do you think that deflation will ultimately, or disinflation will ultimately win out here?
So you mentioned so many things. How many hours do we have here? So
first
of all,
just focus on that last part.
Well, no. I got to correct one thing. You said the Fed can't lower rates because inflation is high. I disagree with that. The Fed can't lower rates because they don't have a framework. If we had a rules-based framework, if the rule dictated that rates could go down, the rule would also stipulate under what circumstances it would go back up.
Right.
The reason we can't go down is because the Fed cannot communicate what it will do and have credibility if it were to go down. And as a result, I think we're stuck a little bit like the environment in the late 90s. There was new technology. At the time, it was .com. These days, it's AI. And there's a growth potential. I 100% agree that there's a higher growth potential. The big difference and the big unknown and the big risk is fiscal deficits. The fiscal situation is much, much worse than in the late 90s. And investors have paid attention, are starting to pay attention. And there are very few things that investors can do to, quote unquote, diversify, to deal with it. And so that, I think, is one of the biggest risks. I do think the deregulatory trend can do a lot. We just saw a few executive orders, and they're being halted by courts and rescinded and this and that. But we will see much more of that.
And so, sorry to interrupt, but just to note on top of that, we've seen the pausing of a lot of expenditures on the government just in this first week. I mean, in terms of first weeks go, we've had like years worth of activity packed into the past week.
Although some of that's being rescinded and because of some court orders, and so we'll have to see how that plays out. But one of the things that this Doge department will do, it will lean on the Supreme Court decision of the Chevron decision, which basically says that administrative bodies can only do so much without congressional approval, and they'll use that in just taking the axe across the board in slashing a lot of things. Now, that will create a lot of headlines. I said one of the better things to invest in this year may be popcorn. The question is, does it make, and people will get very upset because something gets cut and so forth. The question is, will it change the long-term deficit outlook? I don't think so. I think that's going to be marginal, but it can, if those things stand in particular, it can create a higher growth potential by reducing the regulatory burden. So those things do have an impact. There's also going to be tax policy. So many gifts will be given in order to pass that thing that I don't think it's going to have a huge impact, positive impact on the fiscal side. If anything, this is going to be a negative impact on the fiscal side. And so the job market is weakening, clearly. I happen to agree with Powell. The question is, are the annual spirits that are being released, are they going to counter that sufficiently? And I guess we have to differentiate between the real economy and the financial markets. I think on the financial market side, the markets are so top heavy in a few specific tech companies that there's a lot of deflating that may well happen. At the other end of the spectrum, on the investment in the real economy, I can see that the deregulatory trends can create that. And one of the things to keep in mind, in an environment that is over-regulated, and notably where the regulations change every 5 minutes, businesses are incentivized to only invest in projects with a short-term return on capital. It's one of the reasons why software is doing well. Whereas what Trump is really trying to achieve, if I'm not mistaken, is longer-term infrastructure investment. And so there, it remains to be seen how credible these initiatives are. I think there's certainly positive initiatives on the deregulatory side, but in order for that to have the positive impact that people are looking for, more than just worth a few tweets, but having a profound impact, there needs to be credibility that this is a new path that is going to survive the current administration. And in some ways, of course, Congress is needed to achieve that. At the same time, if you dismantle departments enough, you may well set a new tone.
Yeah. Okay. So lots of things to pull on that. Just to ask my question one more time, and just give the one-word answer if you can, or the one-sentence answer. Do you think the risks to inflation are higher or lower going into the rest of 2025?
Yes.
That's a Powell answer.
That's the problem, right? We don't know. Yes, there are deflationary forces. Yes, there are inflationary forces. And the reason why inflation in the 70s was so difficult to get under control is because people misjudged it, right? We have to be humble in that sense, and the Federal Reserve in particular, they have to err on the side of being cautious. They cannot afford to screw this up again, right? So
let me ask this so you can include it in your answer, because one of the journalists, I think it was the one from Yahoo Finance, actually asked Powell, so why don't you just wait to cut until you get to 2%? Like, why try to front run it? Now, Powell has always said, well, there's momentum, we wouldn't want to go too low. But if that's your concern, why not just wait until you see the dead carcass before you start doing anything that's stimulative?
Yeah, that would be rules-based, right? They don't want that because they don't want to pre-commit. They don't want to do this. They don't want to do that. They want to keep the debating club up. And let me just look here. We currently have a 50% chance of a 30% chance of a rate cut in May right now, and
okay. So it's falling.
Yeah, no, it's actually it's 50%. Sorry, this is adding March and April. So it's exactly 51% of a chance of a rate cut in the May meeting. And in some ways, the one thing to keep in mind when you look at market predictions of what the market will do in the future, the market will always price in the risk of the unknown, meaning that there is some shock happening to the system that requires a rate cut. And as you go further out, the odds of that happening are increasing. And so there's always going to be a bias towards lower rate in the future than it would otherwise be. And so when the Federal Reserve says, hey, we can be patient, the market will be pricing in that over time rates may likely come down. Above and beyond what Powell says about his bias, right? He doesn't even consider the risk that he has to tighten, and the reason he doesn't consider the risk is because he's arguing that we already have a tightening bias, and that's good enough for now, right? And of course, coming to your question, when you have a tightening bias long enough, yes, it's going to be deflationary forces that play out. The only thing that plays against that is that on the fiscal side, it's a complete mess, and when you have no fiscal discipline, that can override that nuance game that Powell is trying to play.
Very true. Although it does seem on the margin, the attitude towards fiscal spending has really shifted since the new administration's come in. Right, they're doing things to try to stop spending, curtail spending, spend more efficiently.
Wait. No. That all goes into the popcorn bucket. And I'm sorry that I'm going to insult here probably most of the audience, but Doge is a wonderful entertainment. And by all means, yes, you can change the structure of regulation. But the big elephant in the room is not being addressed. The big elephant in the room is entitlements.
Yeah, it's the big three.
And yeah,
health, social security, and military.
Well, yes, and that's not. I mean, of course, some of those things will get rid of some waste and so forth. And by all means, the initiatives at Doge are overdue, absolutely. And by the way, it's not the first time in history that has happened. It was FDR that created a massive bureaucracy that nobody knew what sort of spending happened anywhere. And then over the decades, several attempts have been made to try to streamline that at least. And now we're taking initiative to actually take the chopping block to get rid of some of these things. And that's all good. But the scale of the issues are so large that this is all, it's great politics, it's absolutely necessary, but it doesn't change the fiscal trajectory. And obviously you just take care of the issues that you can take care of, and maybe another administration is going to take care of the entitlement reform, but you don't win elections by promising tough choices in entitlement reform.
So folks, just on this whole topic here, I recorded a few hours before I recorded with Lacey Hunt, I recorded with former FOMC official Thomas Honig. Another fascinating discussion. We actually got really deep into this exact topic here too, so I won't rehash all that except to say I think that one's coming out, I think this weekend. So keep your eye out for that one. Great discussion, but particularly a deep drill down on that. All right, Axel, I got two more questions for you, then I'm going to turn to the audience's questions. So you made a comment earlier about how we have a very over-concentrated equity market right now. I'm just going to put up this meme. I think most viewers, and Axel, I think you've seen me share this on X, but it's a good image for sort of explaining the precarious nature of the equity market right now, because so much is riding on so few companies. Powell was actually asked about that today, and I was actually a little surprised, where he said, yeah, asset prices are elevated by many metrics right now, especially around AI. Right. So, I mean, he literally just kind of verbally...
That's your irrational exuberance. I mean, the problem with that is Greenspan said that years before the market topped. And I'm not saying the market will top out only in a few years, but it is so darn difficult to predict when that craziness is coming to an end.
Yep. No, totally. But I think the point that, you know, we're back at I don't know if we'd call this Powell's irrational exuberance market moment. He didn't use words exactly like that, but just the fact that he said, yeah, his stocks at least look kind of crazy here. Notable, right? And we've seen, we saw sort of a sucker punch to the market earlier this week when it opened on Monday, when folks were freaked out about the whole DeepSeek release from China. So my question for you, Axel, and it can be quick because I know we could take a whole hour and talk about it. But how concerned are you about the fragility of today's equity markets, given both valuation levels and the overconcentration risk?
Well, I made a parallel to the 90s a few times now, and this is very consistent with a topping out phase of a bull market. Again, I'm not giving investment advice here, but it is consistent that there's some bad news coming, there's some reaction, there's snapback rallies, and again, I'm not giving specific investment advice, but there's competition to AI. Things snap back, and today Trump came out and said, "Oh, we're going to restrict sales of some chips to China," and boom, there's a movement in the other direction again. Those are all and people are going to shrug them off as one-off. It's company specific. It's this and that, and then suddenly you look and says, "Wait a second, we are off substantially from the highs," and it's months later. The Nasdaq peaked in March 2000. The S&P lasted several more months, right? And then of course it took forever for the market to correct. And so when you live these things real time, it is very difficult to say when you're at the top. I did get a call or message from somebody who never talks to me about investments and saying, if there was one great opportunity to buy these shares, then do it now after major correction. And I'm even reluctant to mention it because my speech is censored. And I can't talk about specific securities here, but I think everybody knows which one that is. And I just said, hold your horses maybe and whatnot, right?
Given the source, did that feel sort of like a shoe shine boy moment to you?
It reminded me of things I heard in the 90s and in 2000. Yes.
Okay. All right. Well, look, my last question really is pulling some user questions in here. So it's a good transition. I'm just going to give a tiny bit of context. So as I mentioned, I talked to Thomas Honig a few days ago, and a few days before him, I talked to Michael Howell, and both of them, potentially for somewhat different reasons, but both of them see that the Fed and the central banks around the world are eventually going to have to restart QE. And I'm not necessarily, you have to share that point of view, Axel. In Michael Howell's point of view, he studies liquidity cycles. That's his big thing. But he says it's really more than liquidity cycles. To me, at the highest level, they're debt refinancing cycles. And he sees us going into a big debt refinancing cycle now where a lot of debt is going to be refinancing at higher rates, right? And that is going to be sucking liquidity out of the system, making the system more unstable. And he has a hard time not seeing there being some big correction in the markets at some point in time over the coming year plus or whatever, right? So he thinks to combat that, eventually the central banks are going to have to do QE to try to help ameliorate that. Similarly, Tom Honig thinks that the next time that the markets get into a rough patch, and I sort of pressed him on what does a rough patch mean, but when they start to feel a decent amount of pain, he thinks the central planners are going to step back, and he thinks QE is going to be part of that playbook. So there's been a lot of discussion here in the live chat about QE. Sorry, that wasn't the question. It was this one. Does the Fed have the ability to backstop, fiscal spending with more QE from here? Right now, nobody's talking about QE. The Fed is continuing QT, but I've heard some people say, well, they're not going to do QE again because it created too many problems. Do you believe that's the case, or do you think at some point in the future we're going to see QE again?
So again, lots of topics. First, let me praise the Fed. We don't do that too much on this program.
Go ahead.
The Fed has done a superb program in draining liquidity. They've been able to reduce the balance sheet, the reverse repo facilities, without at this stage causing any challenges. Now, people will say yes, because they still have a big balance sheet. But there were several concerning things on the Fed balance sheet, and they have been able to shrink that without draining liquidity in the market. And so the Fed has learned operationally, and I think that is something worth keeping in mind as we move on. Related to that, part of the reason why I'm not in the we go back to zero with QE camp anytime soon. Now, have big enough a crisis, absolutely they'll do that. But we jumped out of one of the positives of the high inflation environment is that we got knocked out of that zero interest rate environment. So for the time being, we are not in it, and the Fed does have significant space on the downside. The other major change that has happened is that the Fed is getting more comfortable with micromanaging the economy. And I cannot emphasize enough that bailout to the small banks, that is a super targeted lifeline just to the banks. The banks are the kind of the lifeline of the economy in the sense that they amplify the credit that's available in the economy. And if you can prevent a banking crisis with the magic wand that the Fed has, you don't need to go to QE. And so as the Fed has accumulated these tools, if you want to call them such, the need for QE, which is really a very broad brush that's super ineffective, has decreased. And so I wouldn't be surprised that when the next crisis comes about, they just bail out that particular segment of the economy. Now, that, of course, creates the other problem that you're alluding to, and I think that's part of your question, is the Federal Reserve going to finance the deficits? Because the more the Federal Reserve engages in these things, the more they're kind of giving the carrot to Congress, saying, hey, why doesn't Congress require the Federal Reserve to finance a project? I mean, Elizabeth Warren has already made the Fed run the Consumer Financial Protection Bureau, the super unconstitutional, but using the Fed's resources to finance a body so it's shielded from Congress. And so Congress, they may be ineffective, but they're not completely stupid, right? If they see there's a pot of money, they'll try to get it. And the more the Federal Reserve is going down that path. So I'm not sure whether I'm answering your question, but I think the reason why we'll evade for QE longer than what you've just argued about is because the Federal Reserve does more micromanagement of the economy, which will have other unintended consequences. But that's why I don't think we'll have QE anytime soon.
Okay, well, you answered my question. I'm going to pull this question here and make it into a bigger one. So Kitty here asks about the Fed's ability to keep 10-year Treasury bond yields from going up. So, as the Fed started its 100 basis points worth of cuts, the bond vigilantes have taken the long end of the yield curve higher, much to many people's surprise and dismay. What do you expect here on the long end of the curve from here? We saw some immediate reaction today from the Fed release and whatnot, but it's pretty much unchanged since before. It's settled back down. But looking forward from here, what do you think it's going to take to start getting the long end and the short end of the curve to start marching in unison versus against each other?
So the first thing is I'll give you one of these yes answers again, because the long end of the yield curve is influenced by many, many factors. You can think of it, it's the short-term rate, you're kind of cumulative. It can reflect the bond vigilantes. It can reflect the higher growth potential. And by the way, part of the reason I say that is if you bet on the long end of the yield curve, you better know what you're doing, especially if you short the long end of the yield curve, you have to pay the interest. And so it's a negative carry trade, and it can get very, very pricey if you don't have the timing right. I do think that the higher growth potential, the higher deficits, the risk of higher inflation, all warrant that the long end of the yield curve is higher. And by the way, you talked about this big debt refinancing that's necessary. Absolutely, that is necessary. That will take place. We see it play out in the housing market, right? Where transaction volume has kind of grinded to a halt. But as long as the economy is holding up, I think the Federal Reserve will go to its old playbook remember, the rates we have currently are the normal rates, right? What we had last decade is the thing that's not so normal. And so we'll have to see of how this plays out. By the way, the one thing we haven't talked about is, because I do think it's relevant in this context, is China. China has this amazing deflationary implosion because of the housing bubble, and they're noodling around at the edges, providing liquidity and giving you a 20% discount on your Android phone or whatever phone that you're buying in China. This doesn't work to get out of a deflationary spiral, and one of the things that gets you out of those things is a war. That requires inflationary spending. I hope we don't go to that route. But as long as they have social stability in China, they're probably not going to do anything. But there are spillover effects from whatever the Chinese are doing. I just want to mention that in this context, that can have an impact on our rates and beyond.
All right, and just to mention yet another video I did recently, I did an interview with Richard Koo, who used to work for the New York Fed for many decades. Now he's been the chief economist at Nomura. He's based over in Asia, Japan, Taiwan. And we talked for a good while about his thoughts about the balance sheet recession that China is stuck in right now and what he thinks it's going to take for them to get out of it. So if that's an interest,
and he wrote the book on that, of course. Right? He coined that term.
Exactly. Yeah. So if that's of interest to you folks, go check that out. We can just answer this in a sentence or so, Axel. I'm just pulling it up because it's our buddy Neil Smith, who is a good contributor here. Is there any mechanism by which Trump could actually remove Powell, or will he just make Powell's life more miserable until he appoints a successor?
Powell serves a useful purpose. Don't think for a moment that Trump would be any happier if Trump were out tomorrow. Then he has to use the next person to punch him back. He will have part ownership of whoever the successor is.
That's a great point.
So
He'd actually own the results. Yeah.
Yeah. So Powell being there is very convenient. And that is why it's going to. But now, of course, Trump has an ability that he can hire people and then still have them the scapegoat. I mean, that of course he's talented at, but he needs a scapegoat, right? And it's, as I tried to allude to, the Fed is in a tough spot now. I have some ideas how one could fix it by having a better framework, by getting out of politics on everything that you do. It really depends on who the next person is. Powell by now is experienced enough, so it's a bit of it's a video game, right? Get out the popcorn and watch what's going to happen. But I mean, what's going to do, right? The administration has an executive order, get rid of DEI, and the Federal Reserve is required by Dodd-Frank to do DEI. Now you can change the emphasis, but if you're Trump, you're going to lash out at it. The Fed has to continue to do it because it's the law. So obviously emphasis matters and things like that. But it's a good politician screams when they don't like something and complains so that they don't own the problem. So it's somebody else's problem. And Powell and Trump is very, very good at that.
Okay, I'm trying to find this other quote. We've got so many comments in the live chat.
While you look at that, I may have shown that to you last time, so apologies for the repeat, but you asked earlier about kind of, I shrugged off Doge. This is a book that David Stockman, the subtitle here is quite relevant. It says, Why the Reagan Revolution Failed. And this is done by a Republican. And the reason why he talks about the failure of the Reagan Revolution is because the cost of the tax cuts, the cost of all the Reagan reforms were that the deficits blew out. The deficits blew out because politicians don't give a darn about the deficit. They care about their constituents. In order for them to agree to something, they need to get a favor. And that is why a lot of this is political theater, but as far as what I care about is fiscal sustainability. And by the way, the reason I care about fiscal sustainability, because it's important for the social fabric. When you don't have fiscal sustainability, you have more inflation, and it weakens the social fabric, it weakens institutions, it gets people to vote for more populist politicians. Trump wasn't created in a vacuum. And if it wasn't Trump, it would be somebody else, right? And so if we neglect those basic foundations of sound government, it's going to be a less stable environment.
Right. It's kind of like if you don't like what we have now, just wait and see. Yeah, exactly.
And so it's more than the S&P 500 or where interest rates are.
Yeah. And be no surprise to you, but Tom Honig thinks very, very similar to you. And the discussion took some pretty dark turns just in terms of where sort of all this ends. And we'd like to be optimistic in the long run that we'll all choose to do the right things, but we may pursue the wrong path. We may almost need to pursue the wrong path to the point where the pain of continuing it exceeds the pain of change. And that's usually how societies recalibrate.
Well, of course, we know from the European debt crisis that the bond market is the only thing that gets people to move. The U.S. has far more flexibility than the Eurozone countries had, and the only thing I'd like to add to that, there's always a tomorrow. There are folks out there, and we haven't talked about it much, as you know, right? We manage quite a bit of gold and gold mining, 1.7 billion these days, and a lot of the gold bugs that I talk to, they think about the big reset that's going to happen, this and that. There is no light switch. There's a continuum. Right? Some of it is obviously rocky things, but there's always a tomorrow. Look at Latin American societies, right? As they have destroyed their currencies and have inflation, there is life, right? It's the political stability is decreasing, the social fabric is changing, and then once in a while you have a swing back, but there's always a tomorrow. And that is something I think that people need to be aware of, that when you look at these projections, yes, you take certain scenarios into account, and then the question is how to prepare for them, both in the financial markets and in real life.
All right. So Axel, because you brought up gold, I'm going to have to ask you about that too. So I'm going to limit it to 2 more questions, then we'll get to the gold question, then we'll wrap it up at that. So we're going to maybe bleed a few extra minutes beyond the hour, Axel, if that's okay with you.
Yes.
All right.
I hesitate because you have this amazing ability to do this, right? Oh, let's just do another 5 hours. I'm not blaming you, but you're very good at
that. All right. Well, look, I finally found the question I was looking for. So feel free to keep these answers concise, just given the time length that we're going at here. But what does Axel think the impact on the economy will be following the removal of millions of illegal immigrants in the economy? Provided, in fact, they do deport people at that scale. Will that be inflationary or not? And I assume the inflationary argument is, we have a lot of people that are involved in the economy right now working below market wages. And so presumably they would have to be replaced with domestic workers who would demand higher wages.
I think all of that, that's why I keep bringing up popcorn being the best investment. There has to be a shock and awe to stop the momentum of the immense flow of immigrants. Whether indeed, quote unquote, millions will be deported is a completely different topic. There will be high profile arrests. There will be arrests of some offenders who should be in prison, should be this and that. There was just a headline out that Guantanamo is going to be set up a prison camp for 30,000 folks. That's the sort of headline we will seeing. Note it's 30,000, not millions, right? And there will be plenty of outrage and whatnot. The point of that is going to stop many people from even attempting to come over. And so then there's going to be continued lashing out at all of what's happening and what these bad people are doing. From a political point of view, I wouldn't be surprised if it's not going to go dramatically further than that. Now, that said, of course, yes, if you withdrew a bunch of immigrants from the market, who's going to pick the things in the fields? Now, agriculture is actually a very small part of the economy, so that's used a lot. But construction industry, same thing, right? And so those workers are used. Now, the Trump administration has said we can have work visas, we can have this and that. So at this stage, I think a lot of that is politics. If you look at the markets are not pricing in that suddenly millions of people are going to be missing from the labor force. And you may like what Trump is doing, you may not like what Trump is doing. I do think that taking a step back and thinking about why is he saying it and what is the realistic impact that he's going to have, aside of the kind of whether you like the way that he goes about it, right? I think it's worth doing that as an investor, right? I mean, if you do something as somebody who loves or hates certain things, of course, do other things. But as an investor, just try to take a step back and think about what it means for the markets.
All right, wise words. And folks, I'm resisting my standard, follow-up questions on this stuff just because we're pressed for time. But obviously, Axel, lots we could parse into just that answer alone. All right, here is the second to last question I'm going to ask you. What is Axel's view of DeepSeek being a Sputnik event for America? So, yes, Axel, you're a gold guy, a dusty old gold guy, but I happen to know that you are very knowledgeable about technology as well, and you live in the heart of Silicon Valley.
So for full disclosure, I have a master's in computer science with a focus on artificial intelligence. That is a few decades old. But when I studied AI in the late 80s and early 90s, at the risk of dating myself, one of the hallmarks of building neural networks, which is kind of a core ingredient to these AI models, was and continues to be that if you take out a chunk, and these basically neural networks is a way to condense information, and you use linear algebra, matrix manipulation to do this. If you take out a bunch of stuff from that, these models still work quite well. And then the second part of the 90s, there was a lot of investment done on how to make these models more efficient, to use less computing power and whatnot. But just structurally, it is no surprise at all that you can greatly simplify these things. And with the regular chips, kind of have an 80-20 rule that you can achieve 80% of what you can do with the fancy stuff with 20% of the cost. So that sort of shock that DeepSeek is bringing to the table shouldn't come as a surprise. Also, the fact that if you have more specialized algorithms, that you can save a lot of energy in doing this. Now, none of this means that we won't, kind of at the other end of the spectrum, I don't know about you, but I increasingly use ChatGPT and whatnot for searches and as an aid. And the amount of energy that's consumed by doing an AI search versus a Google search is dramatically higher. So from that point of view, and we've just scratched the surface in the sort of things we can do. So this industry is going to grow dramatically. There is going to be competition. I think it's always been extremely naive to think that one company can sell a chip in the tens of thousands of dollars per chip and have that be sustainable. At some point, these costs have to come down. Now, that doesn't mean this technology is not going to evolve further and it's going to influence our lives, but it's part of the reasons, and again, I'm not trying to give investment advice, why people, this was just a wake-up call that this stuff actually happens for real, that there's innovation. And that's kind of what innovation is supposed to be about, right? The question is how big a value you should assign to any one of these players.
Well, that's where I'm going. So let me ask a follow-up question here, which is, I showed my image earlier of the elephant on the beach ball supported by the ants, right? Those ants are the most highly valued companies in the world. And a lot of their valuation has occurred in the past couple of years. And it's been essentially a promise of, them cornering a very large part of the AI market going forward and being able to charge a lot for that. Does the DeepSeek event call into question a material amount of the current market value that's priced into those few companies?
I don't want to get into giving specific investment advice. So
that's why I talk
in generalities,
yeah.
But there were the nifty-50 ones, right? I mean, there is what value do you assign to these things? In the year 2000, stratospheric values were assigned to companies, and then those values plummeted. But it doesn't mean that there weren't some businesses that at the tail end of that came out stronger and at this stage have surpassed some of those valuations. Some of them were created afterwards. And so there is tremendous value in some of the things these guys are doing. I can tell you that personally, I have tried to stay away from having exposure to some of these things. But that's really one of, and for a while already, that's one of more personal style, right? I tend to get defensive earlier than some other investors do. I'd rather miss part of the peak because I think it's impossible to time the peak in the market. And I'm very happy where I'm invested in. I'm on record as an insider buyer in gold mining, quite extensively so. But that doesn't mean these other investments are necessarily bad. It's just that to me, the risk return reward isn't there. And so I'm trying to be as polite as possible in expressing that. Keep in mind that my speech is censored. And so because I'm regulated by the SEC and others, and if I can't just tell you, hey, run for the hills type of things, right? I'd get in trouble if I were to say that. And when you have your guests, you may want to make it clear whether the person you're talking to is regulated or not, because I think it makes a great deal of difference on how they answer some of the questions.
Yeah, no,
so that's why I'm giving you a careful answer here. I'm just telling you that if it were my choice, I wouldn't touch it with a broomstick.
All right, very well.
Broomstick is not a security, so I think I can reference that.
No, very well navigated. Yeah, it's amazing how much more interesting and fun Rick Rule became to interview after he retired from Sprott and was no longer regulated. All right, so we're going to get to the last question, which is around gold, gold mining stocks. Very quickly, folks, please, in the live chat, let me know if you are continuing to enjoy these special events, reports that we're doing more of on this channel. Obviously, you know, these repeating live reaction videos to the Fed whenever the Fed has releases like it did today. You know, it does that several times a year. If you like it, we'll keep doing this with Axel every time the Fed comes out with their latest release. But also earlier this week, we did one around DeepSeek. We did a few last year in regards to some other developments, you know, some of the outbreaks of hostilities in the Middle East and a few other things. So if you appreciate that, let us know in the live chat or the comments below, and we'll try to do more of those going forward. Again, I just want to make sure I'm doing more of whatever you guys value. All right, Axel. So I put out a tweet earlier this morning as gold was making a run to, you know, it's at least all-time high futures price. I'm not sure if it actually hit the all-time high, but it was getting close. And I contrasted it to GDX, which is one of the better known indices for the precious metals mining complex, which is nowhere near its all-time high. And I asked a general question, which is, how is this discrepancy likely to resolve? Will the price of the metal cool, or will the mining stocks themselves catch fire at some point? What's your best explanation for why the miners are continuing to really lag the metals at this point?
All right, how many hours do we have for this one?
Only a couple minutes, my friend.
The short answer is we actually had a webinar on this, and if you go to merkinvestments.com, you can find a link to it, and that goes into that question. But in the interest of time, there are a few drivers. First of all, the mining sector is not created equal. There are the large producers, the medium ones, and development exploration companies. The big miners, they overinvested in the previous bull cycle. Then they were told to get their act together. Then they underinvested, which means they actually have less leverage to the price in gold. They are so large that it's very difficult to replenish the gold that they have, because they just don't find big enough projects to make it worthwhile. And so they've gotten involved in some of these very large copper gold projects that are very difficult to execute on time and on budget. And so these large companies are just suffering from the fact that they're large and unfortunately haven't been managed too well. I happen to think that there's a lot more value in the development companies, the small producers. They're taking bite-sized projects that are run for a much lower gold price, and so they actually have that margin expansion. The inflationary issues are for the most part behind them. Of course, when the price of gold is higher, certain costs can go up, and so it's a little complicated to go into all that in too much detail here. It is always been a volatile space. A lot of investors have been burned, but the side effect of all of that is, yeah.
Yeah, sorry, just your last point though, but a higher gold price is always good for the industry, right?
It is, but the thing to keep in mind, Higher gold price is often associated with high energy prices. Getting gold out of the ground is energy intensive. Higher gold price is often a symptom of other things. So the governments want to have a bigger chunk, the workers want to have a bigger chunk. And if there's a mining boom, there's a shortage of workers. By the way, that's the biggest scarcity in gold is workers, management teams. We invest in management teams to get gold out of the ground more so than anything else. And you think about it, it's a depleting asset. And so you're really investing in a management team to make the decision on where to redeploy that capital if you want to stay in that space. So that's happening in that space. But a lot of investors have been burned. Yeah.
Yeah. Let me just ask my question a little differently because I want to make sure I'm right in this assumption, which is, yes, there are other reasons why gold could go up that have other implications that might, be a drag on the company, but the rise in gold price, my assumption is, will always trump them. Are there instances where the gold price goes up and it's actually net bad for the industry?
No, it's of course it's everything else considered good. Historically, the way that the money flows, it goes into gold, major producers, and then goes to the smaller ones and the developer explorers. These days, the valuations are so depressed that it's actually cheaper to buy the developers than to invest in the explorers and pay them to become a developer. Yeah. So it's there's some, in my view, great values there, but it is, especially if you go downstream, it's a very speculative segment of the market. And so we try to have a venture capital type of approach to that space. And the ETFs that are out there, they just, the ETF market is not built to provide funding to that space. And so that makes it very, very difficult to access that space through an ETF.
Okay. And we've talked a little bit about that, and I'm sure at some point, Axel, we'll have you back on and we'll do, one of our discussions that are big deep dives into gold mining, and you can get in all that. I guess as we wrap up here on this point, as you look to 2025, what's your general outlook for gold and the miners? Do you think it'll be another good year for gold and the miners may play some catch up, or do you have a different default view?
Well, as I alluded to, I've been an insider buyer on the gold mining side, and so I think that speaks for itself.
That speaks a lot, yeah.
It's and in part because there's tremendous catch up in my assessment that might take place. Again, do your homework. There's lots of risks out there in that space. And I'm also on record for being a very substantial investor in the physical gold side. And so, but I try not to time those investments, especially not on the gold side, because first of all, on the mining side, this market can really have a very violent move, both on the upside and the downside, with no notice, right? So it is all but impossible. The part of the reason why we've seen more interest in that space is because it's so difficult to diversify from the Max 7, right? Because they haunt you everywhere. And of course, you can go to cash, right? That's a more defensive thing. But if you want to, the gold miners in particular, because of the volatility, with a fairly small allocation, you can get a lot of diversification. And so that's part of the reason why I've seen more interest in that space.
Okay. All right. Well, look, as we start to wrap up here, I just want to note this comment here from Stan Stinson. Said he loves the Beverly Hills Fed team, Axel and Taggart. Took me a split second, but I realized he was making a reference to Beverly Hills Cop with Eddie Murphy's Axel Foley character, and of course, Sergeant Taggart being a reference.
And there is a new one out there. Netflix has a sequel to the 1980s movies.
I saw it, yeah, and it's got all the same characters in it, same actors.
And Eddie Murphy does a lot less cursing than he did in the 80s. So he's tame. He's calmed down quite a bit.
Yeah, but it was still pretty fun. Although I will say, I can't remember the actor's name that plays Taggart. That guy he's showing his age at this point in time. All right, as we wrap up here, Axel, if folks want to follow you and your work between now and your next appearance here, where should they go?
On Twitter or X at Axel Merk is where I can give live information on what's happening out there. I can't talk about what we do on products on Twitter. So merkinvestments.com is our corporate website. We have a newsletter there. You can go there to look at the products we do and whatnot. But yes, sign up for the newsletter, be engaged, and then maybe back with you one of these days.
All right, great. And I just want to let folks know, if you haven't already heard me say this, too many times already, we've got a phenomenal event coming up in the middle of March, Saturday, March 15th. That's going to be Thoughtful Money's spring online conference. And I got to tell you, folks, the faculty for it is amazing. We've already got Lacey Hunt, doing his usual keynote for it. And I'll tell you, after having talked to Lacey, he's got some great plans for that. We've got Luke Roman and Brent Johnson. They're not on together. That's not a debate between the two, but they are both on in the program. We've got Darius Dale. We've got Michael Howe. So we've got lots of key topics like liquidity, what's going on with liquidity. I've got a bunch of other guests that have just signed on. I'm still finalizing things with them, so I'm not releasing them yet. But I can tell you, folks, I say it every time, I think we've got the best faculty lined up. I think this time it definitely is, and you're going to hear a lot of specific names from me coming over the next week or two. But anyways, if you'd like to attend the conference, highly recommend you go buy your tickets now at thoughtfulmoney.com/conference, because we are offering them at the lowest early bird price that we will be offering here. So I want everybody to get the lowest ticket price. And a reminder, if you are a premium subscriber to our Substack, you'll get an additional $50 off of that early bird price. And if you're wondering how to sign up for the Substack, just go to thoughtfulmoney.com, hit the newsletter link at the top of the page. It'll take you there. You can sign up for free. But again, if you sign up for premium, you'll get that $50 off the conference. And then also, Axel had took great care to say, look, I can't give any personal financial advice. If you would like some help in trying to position for what may lie ahead in the markets, again, I highly recommend you do that under the guidance of a good professional financial advisor who understands all the macro issues that Axel and I have talked about and takes those into account when putting together their portfolio strategy. But if you don't have a good one who's already doing that for you, and you'd like to talk to one of the ones that's endorsed by Thoughtful Money, these are the firms you see with me on this channel week in and week out, feel free to go to thoughtfulmoney.com. Just fill out the short form there, and you can get a free consultation with those firms. It doesn't cost you anything, no commitment to work with those guys. It's just a free public service they offer. Axel, my friend, again, thanks so much for doing this with me yet again. The next one is in March, right? So we'll see everybody here in about 2 months.
We'll see you then. And for a presser where Powell tried to say nothing, we were able to talk about quite a bit.
Yeah, we never run out of things to say. And for those of you who asked questions I couldn't get to, sorry, folks, I did my best. And we'll make sure that we'll just pull as many in as we can in next time around. But Axel, thanks so much again for making this a priority in your very busy day. Everybody else, thanks so much for watching.